Australian dollar to US dollar is ripping higher in the middle of the night, up nearly 0.5%, and every retail trade on the planet is piling in behind the same headline, a US-Iran peace deal that has absolutely no details yet. Think about that. The market is celebrating something that doesn't exist on paper, and that means one thing. This rally is built on pure emotion, and emotional rallies break harder than anything else. Right now, there is one danger zone and one hidden opportunity that nobody is talking about, and I'm going to show you both before this session ends. Stay to the end, because I'm giving you 3 exact levels you can trade today, including a sniper entry that puts you ahead of the entire herd. Here's my instant market verdict for this session. The bias is bullish, but it is dangerously extended into resistance, which means we are fading the breakout attempt until proven otherwise, but we are doing it with surgical precision, not blindly shorting. The trend structure on the monthly chart is a strong buy, weekly is a buy, daily is neutral, but the 5-hour and 1-hour are screaming strong buy. That tells you shorter-term momentum is in control, but the higher timeframes are warning that we are right at a ceiling that has rejected price multiple times. My single invalidation level that flips this entire bias is 0.7048. Write this number down right now, 0.7048. If we get a 4-hour candle close below that level today, the whole bullish structure resets, and we are not looking at a pullback. We are looking at a trapdoor down to 0.7002. Here's where the herd is positioned and why it matters. Retail sentiment trackers show over 65% of traders are already long Australian dollar to US dollar, and institutional positioning data reveals leveraged funds added to long Aussie contracts last week. That means the easy money on the long side has already been made, and if this peace deal narrative cracks, there is a massive pool of liquidity sitting right below 0.7050 just waiting to be taken out. The smart money knows that. And that is why the next 48 hours are a minefield. Let's go into the technical deep dive. I want you to visualize the chart with me from the weekly all the way down to the 60-minute. On the weekly, the 200-week moving average is way down at 0.6892, and price is holding comfortably above it. That long-term gradient is sloping up, which confirms the structural bull trend is intact. But here's what most traders miss when they only look at the weekly. On the daily chart, price is trapped underneath a tight convergence of the 20-day moving average at 0.7098 and the 50-day moving average at 0.7112. These two averages have been acting like a brick wall for the last several sessions, and every time price has approached, sellers have stepped in. That's the daily neutral reading coming to life. We are coiling right underneath these averages, and the 14-day ADX is reading 33, which means the trend is very strong, but it doesn't tell you the direction, it just tells you an explosion is coming. The 1-hour and 5-hour charts are showing a series of aggressive higher lows, and the 100-hour moving average has turned up to 0.7037, which is providing a dynamic support underneath the market. Now, let's talk about the momentum signals that separate winners from losers. Look at this 4-hour MACD. It's still negative, printing minus 0.003, but the signal line is hooking up, and we are seeing a classic momentum convergence where price is making higher highs and the MACD histogram is starting to accelerate higher. This is not a bearish divergence, it's an early-stage bullish reversal signal on the lower time frame, but, and this is critical, if price pushes above 0.7100 and the daily MACD does not follow with a higher high, we will get a hidden bearish divergence on the daily chart. That would be the trap signal that catches every breakout chaser off guard. The daily RSI is at 46.7, which is nowhere near overbought. That tells you there is plenty of room for this thing to run higher if the resistance gives way. The stochastic is at 36, climbing out of the basement, and Williams %R is at minus 53, all of which supports the idea that momentum is not exhausted. But remember, momentum in a range is just noise until the range breaks. Right now, the range is defined by support at 0.7048 and resistance at 0.7114. Let me give you the exact levels you need tattooed on your screen. Immediate support, S1, is 0.7048. Below that, S2 sits at 0.7022, and S3, the last line of defense before a full-scale rout, is 0.7002. On the resistance side, R1 is 0.7094, R2 is 0.7114, and R3 is 0.7140. The pivot point for today's session is 0.7068. Notice how price is currently trading at 0.7080, which is exactly between the pivot and R1. This is no man's land. The real battle begins at 0.7094. A 1-hour close above 0.7094 opens the door to 0.7114, and a break above 0.7114 with volume targets 0.7140. On the downside, a break below the pivot at 0.7068 puts 0.7048 back into play. Here's the cross-asset linkage you need to understand. Australian dollar to US dollar is the China proxy. It moves tick for tick with iron ore futures, copper, and the S&P 500. Right now, copper is up 1.2%, iron ore is bid, and US equity futures are green on that peace deal headline. So the correlation confirms the risk on bid. But gold is also holding firm, which tells you there is still a fear bid lurking underneath the surface. That's the geopolitical hedge. The market is pricing in peace, but it's hedging for chaos. That divergence is the hidden signal at the 3-minute mark. When you see risk assets bid and gold bid at the same time, it means the move is fragile. It means this rally can reverse in a heartbeat. The next signal changes everything, and it's coming from the fundamental side. Let's connect the last 24 hours of news directly to the price action. Yesterday, headlines hit that the US and Iran were closing in on a peace agreement framework. The dollar index dropped instantly, and the Aussie ripped 40 pips in under an hour. But here's what changed everything that nobody is talking about. There are no details. No ceasefire date, no sanctions relief timeline, no verification mechanism. The market reacted to the headline, not the substance. That's a classic buy the rumor, sell the fact setup. Except we are now entering a blockbuster central bank week. We have the RBA minutes tomorrow, the Fed minutes the day after, and a speech from the PBOC that could move the yuan and, by extension, the Aussie. If the Fed minutes reveal that committee members are still split on the pace of rate cuts, the dollar will squeeze violently, and that will crush Australian dollar to US dollar right back through 0.7050. The policy divergence between the RBA, which is still on hold, and the Fed, which is being priced for a cut, is the entire ball game. If that spread starts moving in the dollar's favor again, the Aussie's yield advantage evaporates. My 1 to 2 week directional lean is cautiously bullish, but only on the condition that price holds above 0.7048 and the peace deal narrative doesn't implode. The exact event that invalidates that lean is a daily close below 0.7002. That's the emergency break. If that happens, the next stop is 0.6892. I need you to participate right now. Do you think the dollar index breaks 103 this week? Comment yes or no below. I'm tracking consensus, and I'll be responding to the best takes in the comment section. Most people skip this next section because they think the plan is already obvious. That's exactly where the money is made. Keep watching. I'm about to lay out 3 trade setups: conservative, standard, and high risk, with exact triggers, exact stops, and exact targets that you can screenshot and trade tomorrow. Do not skip this. Strategy 1. The sniper. This is the conservative breakout play for traders who want confirmation before committing capital. Here's the exact trigger condition. You wait for a 1-hour candle close above 0.7105. Not a wick, not a spike, a body close above that level on the 1-hour time frame. Why 0.7105? Because that clears the 20-day moving average, the psychological 0.7100 barrier, and the upper boundary of the recent consolidation all at once. Once that candle prints, you enter long on the immediate retest of 0.7105 or on the next candle open. Your stop loss goes at 0.7065. That's just below today's pivot and beneath the intraday support zone that has held all session. That gives the trade about 40 pips of breathing room, which is essential for a breakout that might get tested. Your take profit 1 is 0.7140, which is the R3 resistance and a structural swing high. Take profit 2 is 0.7170, a measured move target based on a range between the pivot and the breakout point. The risk-reward on this setup is 1 to 2.7, which is well within institutional parameters. What voids this setup entirely? If price falls back below 0.7048 before your entry triggers, the breakout is a fake, and you stand aside. Also, if the breakout candle has a long upper wick longer than the body, it signals rejection and you do not take the trade. Patience is the edge here. The sniper, conservative, entry, 0.7105, 1H close above, stop loss, 0.7065 take profit 1, 0.7140 take profit 2, 0.7170 risk, reward, 1:2.7 invalidation, void if price breaks below 0.7048 before entry or breakout candle wick exceeds body. Strategy 2. The active trader. This is the standard mean reversion play for those who want to buy the pullback, not the breakout. The entry condition is a dip into the 0.7048 to 0.7050 demand zone. That's S1 support, and it aligns with the 100-hour moving average, which is now rising at 0.7037. You don't just place a limit order and walk away. You wait for a bullish 15-minute reversal signal, like a hammer or an engulfing candle closing above 0.7050. Once that prints, you enter long. Your stop loss goes at 0.7020, which is below the S2 support and below the last significant swing low. That's a 30 pip risk. Your take profit 1 is 0.7094, which is a 1 and likely to act as a magnet on the first leg. Once target 1 is hit, immediately move your stop to break even. Your take profit 2 is 0.7114, R2, and this is where you let the runner ride. If the market has real momentum, you can trail your stop using a 15-period moving average on the 15-minute chart once price clears 0.7100. The beauty of this setup is that you're entering where liquidity is resting, and you're participating in the risk on bid without chasing. The invalidation is a 15-minute. Close below 0.7020. If that happens, the buying pressure is gone and you do not re-enter until the structure resets. Type your Australian dollar to US dollar range for tomorrow in the comments right now. Give me a high and a low. Let's see who's aligned with the smart money. I read every single one, and I'll pin the most accurate after the session. The active trader, standard, entry, 0.7048 to 0.7050, bullish 15M reversal candle, stop loss, 0.7020 take profit 1, 0.7094 take profit 2, 0.7114 trailing stop, move stop to break even after TP1 hit, trail with 15 MA on 15M above 0.7100. Invalidation, 15M close below 0.7020. Strategy 3. The aggressor. This is the high-risk, counter-trend short for traders who can read rejection at the brick wall and want to scalp the failure. Here's the exact entry condition. You need a clear rejection at the 0.7100 zone. Specifically, a 5-minute bearish engulfing candle that closes back below 0.7095 with a spike in volume. Once that candle closes, you enter short on the break of its low, around 0.7090. Your stop loss is tight, above the rejection wick high at 0.7115. That's a 25 pip risk. Your take profit 1 is the pivot at 0.7068, and take profit 2 is the S1 support at 0.7048. If price stalls at 0.7068 and prints a bullish reversal, you close the entire position and walk away. This is not a swing trade. This is a scalp that exploits the euphoria of the breakout chasers who will get trapped if the resistance holds. The warning is explicit. This is only for traders who can lose small and manage risk aggressively. If 0.7115 breaks to the upside, you do not add, you do not hope, you get out immediately. The momentum will be against you, and fighting the trend when it breaks a major level is account suicide, the aggressor, high risk, entry. 0.7090, on break of 5M bearish engulfing low after 0.7100 rejection, stop loss. 0.7115 take profit 1. 0.7068 take profit 2. 0.7048 risk, reward. 1:1.8 invalidation. Break above 0.7115. No re-entry. Here's your risk management pulse. This is non-negotiable. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news events like the Fed minutes or RBA releases. Stops are set in stone the moment you enter. Do not move them wider in hope. This is how you survive to trade the next massive move. Discipline is the only edge that compounds. Let's close this out with the single most critical level for the next session, and a retention loop you cannot afford to miss. The level is 0.7100. Everything changes on a daily close above or below that number. A daily close above 0.7100, and I mean a convincing close with no long wick, opens the melt up to 0.7170 and potentially 0.72. That's the scenario where the peace deal holds, the Fed minutes sound dovish, and iron ore goes vertical. A daily close back below 0.7048, however, and the trap is sprung. That's the scenario where the smart money uses the liquidity above 0.71 to load short positions, and we tumble toward 0.7002, and then the 200-week moving average at 0.6892. Tomorrow's wildcard is the RBA minutes and the China industrial profit data. Either one could send the Aussie flying or crashing before New York even wakes up. I'll be here, same time, breaking it all down with the same institutional precision. If you want the full breakdown on Bitcoin and the S&P divergence right now, that video is live on the end screen. Tap it because the correlation signal I'm seeing there is one of the most dangerous setups of the month. Smash the like button if this gave you a clear, actionable plan. Subscribe, hit the bell, and I'll see you in the next one, before the next explosive move leaves the crowd behind.